Okay, so let's unpack this. Today, we're diving into CoreWeave's latest financial report. They're a company that's, really shaking up the AI infrastructure world. They just dropped their Q2 2025 earnings. It's their second as a public company. And for you, our mission today is really to cut through the noise, all the numbers. We want to understand what CoreWeave's performance really tells us about this huge demand for AI compute. And we're going to try and keep it simple. Look at the good, the bad, and yeah, maybe a little bit of the ugly too.
Absolutely. And what's really fascinating here, I think, is how CoreWeave's whole story, it just mirrors the intense investment happening in AI right now. It's almost dizzying.
Yeah.
So we'll look at the details, the really impressive wins, but also the significant challenges, and try to figure out why it all matters for where they go next.
Okay, let's jump right in then. The good news first. CoreWeave absolutely blew past revenue expectations. I mean, crushed them. They reported $1.21 billion in revenue. That's what, 206% up from Q2 last year? Huge.
Just massive growth. And, connecting that to the bigger picture, it wasn't just a fluke. A one-off quarter, they actually raised their full-year revenue guidance. Now they're expecting somewhere between $5.15 billion and $5.35 billion.
Yeah.
That signals really robust, sustained demand for what they're offering.
And they definitely seem to have the demand. Their revenue backlog, basically money they're already lined up to get it jumped to an incredible $30.1 billion. That's with big multi-year deals like expanding with OpenAI, plus new wins, right? Goldman Sachs, Morgan Stanley, big names. And they were the first ones offering those new NVIDIA GB200 systems at scale.
That's key hardware. Yeah, that's critical stuff. The CEO, Michael Intrater, he really highlighted that momentum, said they're scaling rapidly to meet unprecedented demand.
So that strong top line, it's clearly driven by them being, well, essential in a market where supply is tight.
Okay, but despite all that amazing revenue growth, there's another side to this that caught my eye. What's going on with profitability? Because that looked different. Right, this is where it gets really interesting. Because despite that massive revenue, the company reported wider losses than analysts expected. Adjusted EPS loss was $0.27. GAAP EPS loss, the official number was $0.60. Both missed expectations. So it was raised that big question, why the losses when revenue is booming like that?
And I guess that leads straight to the cost side of the equation, doesn't it?
Exactly. Operating expenses just soared up to $1.19 billion. That's a 275% increase year over year. Just staggering. And a pretty big chunk of that, $145 million, was stock-based compensation, paying employees with stock or options. So while it's not all immediate cash going out, it definitely impacts the bottom line profit number. This kind of regressive expansion, it just comes at a really steep price, hitting profitability hard.
Right. And looking at their cash flow, it tells a similar story. Lots of investment, right? Free cash flow is negative. $251.25 million. It feels like they're building something huge fast and pouring money into it. Their Q2 CapEx spending on hardware data centers was between $3 billion and $3.5 billion. That's a lot.
A huge amount.
Yeah.
And you see the impact directly on profitability. Their operating margin, how much profit from core operations per dollar of sales, it shrank dramatically, down to just 2%. It was 20% a year ago. That huge drop is largely driven by those costs we talked about, especially the stock-based comp.
And while they're investing so heavily, their total debt, well, it's ballooned, hasn't it? Up to $11.1 billion. That number really reflects just how much capital they need for this expansion. It's like fueling a rocket ship.
It really is. And while this makes widening losses, super high operating costs, lots of debt, it definitely spooked the market a bit. CoreWeave shares dropped, 5.9% to 9% in after-hours, trading right after the report. You even saw some chatter online calling it a bubble, people worried about the cash burn. And they have a working capital deficit, too, which isn't ideal for short-term flexibility. Plus, there's an IPO lockup expiration coming soon, which could mean more selling pressure. So, yeah, the market seems a bit nervous, even with all the AI excitement.
Okay, so let's try and sum this up. What does this all mean for you listening? You've got a company, CoreWeave, experiencing truly explosive growth. It's undeniable, fueled by this almost insatiable demand for AI compute power. But that growth comes with equally explosive costs, and that's leading to big losses and rising debt.
Yeah, it's the classic high-stakes scaling game, especially in a hyper-growth market like AI infrastructure. It's not like software. You need massive capital upfront for the hardware. They are making strategic moves, though. They acquired Weights and Biases. They're planning huge data centers. They're aiming for more vertical integration, owning more of the process, hoping to save maybe $500 million a year by 2027. and also trying to cut future lease costs through acquisitions. So they are thinking long-term.
It really is a high-risk, high-reward situation playing out right now. So the question for you to think about is, how much aggressive spending is too much, even in this AI boom? And, how long can a company keep expanding like this before those margins absolutely have to improve?
Exactly. Only time will tell if this huge upfront bet pays off with, sustainable profits and real market dominance down the road. Makes you wonder, looking at these numbers, what really stands out most to you?